What's up, future home buyers? My name is Chris, aka CI the Mortgage Guy, and I'm back with another video about giving you guys some tips on getting a mortgage and buying a home. So today's video I'm going to discuss why maxing out that pre-qualification letter is a bad idea. Usually pre-qual letters are at the maximum you qualify for. So let's say, for instance, you may be wanting a home for $250,000. If you qualify for more, they'll actually max it out. So first things first, I'm going to bring the iPad on the screen so we can go over a few questions that you may have about pre-qual letters and why maxing it out might be a bad idea for you, okay? All right, now that I got the iPad on the screen, I'm going to go over some of the questions that you may have about pre-qualification and why maxing it out might be a bad idea, okay? So for the first question, most people are asking, what does it mean to be pre-qualified? And layman's terms, based off the information you provided, you may qualify for a home at X amount. So if you see here, I put in red May. I'm even gonna highlight it there. What that means is you basically had a conversation with a mortgage advisor or a mortgage lender, and you told them how much money you make, what your credit score is like. You may have already ran your credit, or they did a soft credit check for you. You told them your address history. You basically filled out all the detail, and you had a conversation, and then they told you, well, this is what you would qualify for if all the information that you said to me stands true. Nobody's checked your credit to see if you had any bankruptcies or late payments or something on there that's, that has to be paid off before you actually can qualify for a home, and you haven't even done a full application yet. So this is just conversational. It can get confused, and in today's market, these pre-qual letters, they're pretty much useless. You got to go for pre-approval, and later on in the video, I'll show you the difference between the two. How do I become approved or pre-approved? So you have to complete the online application. There's 5 steps to complete an online application. You submit the required documents. Those documents are income. Those few documents there, they're going to request from you. Your mortgage lender will provide the list of documents needed. And then the sooner you submit those, the sooner it can get into underwriting, and they can review and make sure that there's no fallacies in the documents that you submitted. Assets, that's just basically bank statements. And if you have to provide a down payment, they want to make sure that that amount is liquid. What does it mean to be liquid? Liquid means that you have access to the cash right away. It's not like you have a stock that's worth a certain amount. You would have to sell that stock and then have that money in your bank account. And then also credit, you just run your credit and then it has to be reviewed, and underwriting has to make sure that there's no delinquencies in your credit. And then you're gonna get disclosures. These are important. It's probably too many pages of them, but you'll go through those, and then once you review and sign them, you'll either be pre-approved or denied. Now, the important question of the day. At this point, if you submitted a pre-qualification and you're waiting for a lender to get back to you, and they finally get back to you, and you come back and say, well, Chris, I've been approved for X amount, maybe $300,000. Does this mean that you should take it out? You see, I'm gonna zoom in on this one, and I'll do you a favor and highlight it, and then I'll circle it as well. No, you should not take out all of the money that you qualify for. Terrible idea, and me as a mortgage advisor, I think any other loan originator would tell you, if they took the time to go through your financial information instead of just giving you some documents to sign and hoping that you get a home. If anybody tells you to max out that, they're probably not going for your best interest, and you need to have a mortgage advisor on your team to be able to go over and let you know some of this finance advice. This is something that you're signing for usually for about 30 years, and if the person that you're working with in the mortgage company isn't giving you advice as well as also giving you a mortgage, you should probably choose another lender. So the reason you shouldn't max out this pre-qualification, for one, most pre-qual letters are based off an extremely high debt to income ratio. What I mean by that, debt to income ratio is basically how much debt you had and then divided by your income. Do that quickly, it's simple math, and then whatever number, you're gonna get a decimal, convert into a percentage, and then it has to usually be under a certain number. In most cases, for conventional loans, it has to be under 46%, which means that whatever you qualify for, including your current liabilities, has to be under 46%. This is called back-end debt-to-income ratio. And then for FHA loans, this is gonna vary a bunch through lenders, but in most cases, it can be above 50% for your debt to income ratio, and you don't need a financial advisor to tell you that that's a bad idea. And then on top of this, let's do some numbers here, okay? So when a lender asks you for your income documents, you know, it's going to be based off of your gross income. Let's say you work for a company and then they offered you a $60,000 job. Doesn't mean you take home $60,000. You're going to take home $60,000 minus the taxes, minus the insurance, and then minus whatever else you have to pay, like child support. This goes based off of gross income, and a lot of people don't account for that. Another reason why taking out this maximum amount is bad, because it only accounts for liabilities that are shown on credit. This is kind of a hidden reason why it's bad for you, because if you think about it, what's on your credit? Usually car payments, credit card bills. What else can you add on your credit? Those are usually the top two. Student loans as well. But what about utilities? That doesn't account for that. What about the HOA fee that you may end up encountering? It doesn't account for that. Grocery bills. It doesn't account for all of those things, and you can have a total housing expense of above 55%, or 50% or higher. And think about that, like you're spending over 55% on your housing expense alone. In what world would you ever want your debt to income ratio for one expense, just one expense, to be at 46%? Now let's just take away the fact that it's gross income. Where would you want to spend 46 or higher percent of your income on? That doesn't make any sense. You're going to go into being house poor, and this is why you need to actually go for mortgage advisors than trying to shop around for the cheapest mortgage. Shopping around for your mortgage is not like shopping around for a flat screen TV, and if you make it a commodity, you're going to put yourself in a financial bind. 46%, 50%. Honestly, for your housing expense, I don't think it should be more than 25%, and that's just my opinion. There are other people that say 25 to 30%, and I've heard even as low as 20%, but it's in that 20% area. When you get above that 30%, 33% on just one expense, it better be an investment property or something like that. It better be something that's bringing you income, or it's a house hack and you understand that the fact that you're renting out that room, that's the only way you can really justify having a debt to income ratio of above 40%. You know, you're going to qualify for it. That's completely fine. And somebody who's just giving you random mortgages and you're just shopping around for a rate and you're not really caring about what's the best financial advice you can get, then fine, go into that and then take out that maximum cash out. And then God forbid anything goes down where you're going to put yourself in a situation where you need extra money and you have to take from that mortgage. Because playing around with 46%, leaving you about 54% left in your income, not accounting for the fact that it's gross income, that's up to you. On this channel, I'm going to give you guys the best financial advice I can give you. Having a situation where you're already in a financial strangle, where money is tight for you, then getting a home isn't the best decision for you. Find a way to be able to create more income so when you do get a home, it doesn't become a liability. It doesn't make any sense to take out more debt if you can't control the debt that you currently have. If you're having trouble paying off your credit card bills, if you're having trouble paying your utilities, if the rent that you have, and sometimes it's more expensive, I understand that, but if you can't pay your rent, then getting a home isn't the best decision for you, because you're just adding on more debt. Make getting a home a good time. Don't make getting a home something that you kind of are going to regret. Really ask yourself those deep questions. Are you financially stable? Do you have enough income to support, a home, an additional home, or any expenses that may occur, like if the roof needs to be replaced or the windows need to be replaced, certain things like that. Don't just get in a home because everybody else is doing that. Everybody else doesn't make the same amount of income as you. Everybody else doesn't have the children that you have. Everybody else doesn't have the type of liabilities, the same type of car that you have. You're going to catch yourself in a situation where you might be asking yourself, is this a good idea? Was this a good idea that you set yourself into? You're going to catch yourself in a situation where every penny you make is going to go towards this housing expense. Okay? Manage your risk. You have the opportunity to. Don't go and take out any more debt if you can't control the debt that you have right now, okay? Whether it be find a way to make more income, invest in stock markets or life insurance or some type of investment, whether it be figure out where you're spending your income and structure your income. And I'll make a video on how you should structure your income, because I do have insight on that. You should structure your income accordingly. How much you spend on bills, or it should be a percentage, how much you spend on investments, how much you spend on your housing expense. These things need to be figured out before you add on more debt. Buying a home is one of the biggest things you can do living in America, okay? It has a lot of upside, but if you don't prepare, you're gonna find a downside. The few people that actually find the downside, they just go in, they listen to other people, they don't figure out their own situation, and they say things like, oh, so-and-so got a home, so I think I can get a home. Where I'm from, we call those crabs in a bucket. You know, you hear somebody that is doing something, you think they can do it too, but no, you ain't in them shoes. So stop trying to fit the shoes that you ain't in, and really be realistic with yourself. Because at some point, I don't know where you are in your life, but somebody's gonna be dependent on you, okay? And if you have a situation where you're a man or a woman and you want to start your own family, you have a family, and you have somebody that's dependent on you, don't do that to them. Okay, look at them and figure out what you're doing wrong with your finances and how you can make their life better, and then figure out if getting a home is a good idea for you, okay? And I'll see y'all next time. Make sure you like and subscribe. If you have any questions, leave a comment. Follow my Instagram page and ask me any questions. I'll follow back. See you guys next time.